Y Combinator is the first and most successful startup accelerator on the planet. As of October 2019, the cumulative valuation of the top companies that have gone through their program sits at an astounding $155+ billion. Of that, CeedDB estimates that Y Combinator has earned almost $9.4 billion in exits. Now, Y Combinator is the top of the field, and there's a wide range of earning potential for accelerators. Some earn billions, some earn millions, and some haven't earned it all. That being said, the value derived from a company's ability to find, fund, and grow startups in exchange for equity should be acknowledged. Now, what if you had the opportunity to own an accelerator that has million-dollar valuation potential? What if the pre-money valuation was only 6 figures? That's exactly what we'll be exploring today on the Equity Crowdfunding Radar. Welcome to the Equity Crowdfunding Radar, where I take a look at interesting opportunities in the equity crowdfunding space from a novice perspective. If you're not familiar with the business model, startup accelerators use their expertise to help fund and grow promising small businesses and startups. Today, we'll be looking at Shadow Accelerate LLC, which is an upcoming accelerator focused on multifamily construction industry startups. Where did I find this? Is it going to be another Facebook ad, perhaps? No, this time I found it through personal research, which amounted to searching through SEC filings for equity crowdfunding offerings. Are they profitable? No. This company hasn't started operating yet. Market risk? I'm not sure. Although the AGC mentions that the construction industry in the United States generates $1.3 trillion worth of structures each year, the technology spending trends in this space were a bit harder to find, because this accelerator is meant to grow startups in the construction industry. In this article from Plug and Play that I'll leave in the description below, they give a high-level view on the innovation potential for the global construction market. Their high-level takeaways are as follows. 1. The construction industry represents 13% of the world's GDP, with 1% productivity growth over the past 20 years. 2. It's the biggest waste stream in the world, accounting for 25 to 30% of all EU waste. 3. 80% of big construction projects are over budget and 61% are over schedule. So it's costing more money and more time. 4. There's a hyper-fragmentation of the industry with more than 60 different stakeholders. Not quite sure what this means, but imagine like 60 different major players in the construction industry. That's how I interpret it. Now, because I'm inexperienced in the space, I'm not sure how these construction trends impact commercial versus residential or other nuances that should be considered. If you have any additional thoughts or insights on the market risk for this company, feel free to leave those in the comments below, as we usually have good discussions there. Moving on to the product risk, also unsure. Whether this company has the ability to succeed is still TBD, but they do have strong pipeline potential due to their connections to their already established Shadow VC and Shadow Labs businesses. Shadow Labs being their incubator program and Shadow VC being their venture capital program. Now let's talk about the listing info. The platform hosting this raise is InfraShares. This is the first time I had heard of this platform, and so far my experience with it has been okay. Round size. They're looking to raise a minimum of $250,000 and a maximum of $1 million. The pre-money valuation is $100,000 and the minimum investment is $1,000. The type of security offered is a membership LLC interest, and the cost per interest is $1,000. This is slightly different from buying shares or a crowd-safe agreement. Usually companies with regulation crowdfunding offerings are structured as corporations if they're offering shares, and I think LLCs offer the crowd safes. But this particular offering, you're getting direct membership interest in the LLC. There are some potential tax implications here, like reporting on income generated from this type of security, and I'd recommend consulting with your local tax professional on those implications because, once again, I'm just a novice here. I don't know. I'm not a tax professional. How are they going to use the proceeds from this raise? Let's take a look at their filing. I won't get too granular here, but feel free to pause the video and read further. At a high level, if they raise the minimum amount, 80% will go towards funding cohorts, and almost 10% will go towards accrued and future wages. So most of the money that they're raising is going towards funding these small businesses and startups. Let's talk a bit about the program. For context, accelerators typically bring in groups of companies for training and mentorship for a set amount of time. At the end of the program, companies that have graduated often pitch their newly grown businesses to additional investors. For Shadow Accelerate LLC, the cohorts consist of 5 companies. Shadow Accelerate will invest $100,000 at the outset, or the beginning, in crowd-safe notes. The program duration is 20 weeks. As a bonus bit of info, recently, Shadow Accelerate announced the first of the 5 companies planned for their first cohort. It's a company called Savvy, which uses open banking to optimize renter applicant screening. Finally, let's talk potential success signals as well as concerns. First, on the success side, it's a super low valuation, so there's lots of upside. 2, they're projecting 2 times ROI after 18 months. And quite frankly, I believe them. Let me know what you think. Finally, Shadow Labs, which is their, I guess I would call it like a sister incubator program, their companies have raised a total of more than $75 million in funding to date. Those are all strong signals in my opinion. Now let's go on to the concerns. Technically, it's owned and run by one person. I'm not sure what the implications there are, but something that was on my radar. I'm unclear on the strategy for future fundraising. Are they going to continue to raise via Regulation A, or are they simply looking to fund their initial cohorts via equity crowdfunding and then use the subsequent profits to fund future cohorts? So this is primarily a dilution concern. And then finally, and maybe this is the most tangible one, are they going to be able to raise the minimum amount? It looks like they've only raised 3.6% of the maximum raise, so they've raised about $36,000, and they're looking to raise $250,000. So that'll be interesting to see if they're able to make it. All right, that's it for this episode of the Equity Crowdfunding Radar. Please let me know what you think of this company. All thoughts and comments appreciated. And feel free to invest in that subscribe button as well as the like button. Hope you have a good rest of the day and happy investing. Bye-bye.